we are looking at the consumer surplus, and we had a diagram that was illustrating the consumer surplus. We realized that on the diagram you can indicate a consumer surplus. What is the surplus likely to be? And therefore, when you are looking at the consumer surplus, there are two ways. You can look at the consumer surplus by diagram, though even the diagram comes from the calculation. In economics, it will be very difficult to avoid calculations. Calculations are a must. That's why in the introduction, I think we mentioned that to do economics in Uganda today, you must have passed mathematics. And even if you didn't pass it and you force yourself to do it, you must make sure that you do sub-math. If you are pure arts, you do sub-math. If you are not pure arts, you are going to do mathematics as a principal subject. So calculations in economics are inevitable. They must be there, and you must come across them in almost all topics that we are going to handle in economics. Almost all topics, there will be calculation. At least some bit of calculation. So it is important that you get used to this kind of teaching, that there must be mathematics. So when we come to consumer surplus, we are looking at the figures now. Those who could not understand it well on the diagram, now it comes to figures. We have to recall that consumer surplus is the difference between what the consumer expected expenditure and the actual expenditure. Expected expenditure and the actual expenditure. And this one comes in the market price difference. What you expected to pay and what you actually pay. And that comes when the market price is realized that it is lower than what you expected to pay. This is a demand schedule. This is a demand schedule for an individual. This individual, whom you can call individual X, wanted to buy this a certain commodity. Let's call it sugar. He wanted to buy sugar. And when he was leaving his home, he had different prices, following utility and following the willingness. Which utility determines the willingness. This person was to buy 8 kilograms of sugar. He is ready to pay the first kilogram at 300 shillings. The second unit or second kilogram is ready to pay 150. The third one is ready to pay 100 shillings. And the fourth is ready to pay 80 shillings. On the fifth is ready to pay 60. You see that the price is willing to pay keeps on reducing. Why is it reducing? Is what we said earlier, utility. Each kilogram is giving him less utility than the previous one. So on the 6th, he pays 50, and the 7th, he pays this, and the 8th, he pays 30. These are shillings. We have to put there. Shillings, which he has to spend. He pays, these are shillings. So this is how his demand schedule is. His demand schedule is like this. He's is ready to buy this at this at this at this. You can take time and draw a demand curve for this. Actually, we can draw it later on and see how it is, and we even see the consumer surplus. But let us first look at the mathematics of it. The mathematics of it is showing us how much he is going to have as consumer surplus. And when you look at we say that the consumer surplus is 30 shillings. Consumer surplus is 30 shillings. Now, when you draw this, put this table on a diagram, you are going to see the consumer surplus, which we illustrated in our previous lesson. So, we now use the mathematical part of it. This sugar, this is what he was willing when he was in his house, was willing to spend. He sits down as he budgets and says, the first kilogram of sugar, if they sell it at 300, I can buy a kilo. But the second one, I will only buy it when it is 150. And the third one, so he leaves home ready to buy these kilograms, but he has made his schedule that for me, I'm ready to buy these kilograms. The first one at this one at this, and so on. So he draws his table. But when he reaches the market, he realizes that the market price is lower than all these. Prices he's ready to pay. The market price is 30 shillings. Remember, his first kilogram is ready to spend 300 shillings. Now he finds the price is 30 shillings. So on the first kilogram, he has a consumer surplus of 270. On his second kilogram, he was willing to pay 150, it is at 30. So he has a surplus of 120. He was willing to pay the third one at 100 shillings. He finds it at 30. There's a surplus of 70. He was willing to pay 80, but that is on the fourth. But he finds the price at 30. So there is a surplus of 50. 60, a surplus of 30. 50, a surplus of 20. 40, a surplus of 10. But the eighth kilogram, it is the market price. So there is no surplus here, 0. Now he has to total up all the surplus that he has got, that he has obtained from his demand schedule. His demand schedule is showing that 8 kilograms are going to be bought at a total of this. At a total of this. Now, if he buys it at a total of this, this is his total. This is his total surplus. So you can total up all this and see the difference between this and this is the one which is going to be the difference between this and the 8 times 30 is what is going to be the consumer surplus. So if we assume the market price is this, we have already known that market price is that. We can do this. Market price is 30. How we can put it here? When market price is 30 shillings. We want to find out this surplus. Let us calculate the figures from the table itself. So we have to add up this. This is 450, 550, 630, 690, 740, 780, 800, 780, 810. So there's 810. Hope our calculation is correct. You can add up and see. This is 300 plus this 450, 550, 630, 690, 740, 780, 810. That is what he expected to spend on the 8 kilograms of sugar. Given his declining utility, his marginal utility keeps on reducing. So as marginal utility keeps on reducing, he is willing to pay less and less. But at the end of the day, the total expenditure is expected with the declining utility is expected to spend 810. This is his budgeted expenditure, which is going to make on the sugar. So he's going to spend 810 as the total expenditure. This is the total utility. In other words, this is the total utility. When we add up all these, what is willing, he is expected to spend. If we measure it in terms of money, this is the utility. Total utility is this. This one is going to tell you to take you to something else when we come to the calculations. Now, this is the total utility. This is the total expenditure he's planning to have on the 8 units. But when he goes to the market, he's going to spend the 8 units. He's going to spend 30 shillings times 80. So it is 30 shillings times 80 times 8. Sorry. All the 8 units are going to be bought at 30 shillings times 80. So times 8. These are the 8 units, and each unit now he has found the market price is constant. It's not what the market price is not looking at his utility. The market price is looking at just what the price is. But at home, this is what he planned with his family. I'm going to buy 1 kilogram of sugar. The first one I can buy it at that, but the second one, no. I'll buy it at half the cost. Now, if he makes his budget 8 units, he goes to the market, he finds that in the market, it is 30 shillings per kilogram. So he decides to buy all the 8 at a go. When he buys all the 8 at a go, he gets 240. That is what he's going to spend on. 240. He planned to spend 810. But when he gets the market price lower for the 8, he is going to spend 240. But his budget, which he had put aside, is 240. Meaning what? Now he has a surplus. When you add this to this, you are going to get this. Check the mathematics and see. 570 plus 240. Now this consumer surplus, the money has got the extra utility he is enjoying at no cost. He's enjoying 8 units, but he's enjoying excess of what? The utility is higher. So this utility, the surplus is showing us that he's enjoying a satisfaction which he has not paid for. He actually, to him, it is free. He expected to spend this, now he is spending this. So he has a surplus of 570. 570 is his surplus. So this 570 is the consumer surplus. And this consumer surplus, we are going to see how important it is. This is consumer behavior, and this is consumer benefit. We are saying if this consumer has his budget and his utility, So this is, I told you this is his demand schedule. This one and this one is a demand schedule. So we are going to find out now what is going to be the surplus. What benefit, utility is this man going to enjoy as a result of a lower price for the commodity he's buying? So he's buying 8 units where he budgeted to spend 810, but when he gets to the market price, he's spending 30 times 8, so his total expenditure is 240, making a surplus. So if he went to the market with the 810, after buying his 8 kilograms of sugar, he's now finding 570 as his surplus. Remember I told you, our consumer surplus is not excess, because surplus sometimes in English means it is excess. You have a surplus, you have this, but you get something addition. No, it is addition because of the market price. This one is what remains when you have spent on the commodities that you wanted. This man has got his total utility of 8 commodities, but he has measured his total utility to be 810 on the 8 units. Fortunately, he goes to the market and he finds that the utility has been achieved at 240. So he pockets his 570. So when you are calculating this, consumer surplus, it is very, very important to see that you can look at it in this way, or you can have a different presentation, still mathematical. Total expenditure, you can say, if this is the table, you may not draw it like this. You may just calculate it to say, what is the total expenditure? Total expenditure. Sometimes this total expenditure is called the total utility. The total utility a consumer is going to get. And the total utility is what we have done here. It is 300 plus 150 plus 100 plus 80 plus 60 plus 50 plus 40 plus 30. That one gives you the 810, which you have put in the table here. But when this man gets to the market, he realizes that what is going to be his actual expenditure on 8 commodities. He's going to spend 8 commodities times 30 shillings. Why 30 shillings? Because that's what he has found in the market as the market price. So instead of spending his total planned expenditure, total utility, he's going to spend 240 shillings. So when we are looking at the consumer surplus, we say it is the difference between what you expected to spend, expected expenditure, and the actual expenditure. It is the difference between the actual expected expenditure minus the actual expenditure. What was the actual expenditure? The actual expenditure was 240. The expected was 810 minus. So you get 570 as consumer surplus. So he gets it as consumer surplus. This is what he is having as balance from his actual expenditure. So this is how you can calculate it. If you have been given this table, earlier on we looked at the diagram and we saw how we calculated on the diagram. But now we are looking at the mathematical presentation, the mathematics. How do you calculate the consumer surplus? you get the total expected expenditure minus the actual. Where do we get the actual? We look at the market price. There's no way where you are going to calculate the actual expenditure. There's no way you are going to calculate the actual expenditure unless you get the market price. So without the market price, there is no way you can get the actual. Market price is the one which is going to give us the actual. So this is what we call the market, the consumer surplus. So if they say the consumer surplus, it is the difference between what the consumer expects, the difference between what the consumer expected or planned to spend on a given amount of commodities and what he actually spends on those commodities. That is the consumer surplus. This is now a schedule of his expenditure. But this schedule, the surplus may not only be on a schedule. It can be even on just one commodity, one item. You are going to the market, and you are planning to buy, as I said, you want to buy a radio. You leave home with a budget. I'm going to buy this radio at 70,000 shillings. When you reach the market, they tell you the radio is 60,000. By mentioning that price already, you have got 10,000 consumer surplus. Now, what happens in the market? There is what we call bargaining, but in economics we call it haggling. Haggling is the same as bargaining. We shall see it when we are looking at the price determination, how we determine prices for commodities. Haggling is bargaining. When we are bargaining in economics, we are looking at two things: either to bring your expenditure within your planned expenditure. There are two situations. When I come to buy a radio and you tell me the price and you go into haggling, into bargaining, what am I looking for? For you who is doing it, you may not know what you're doing. But in economics, what you are actually doing, what you are actually looking at is, are you pushing this seller into your planned expenditure? For example, if I left home ready to buy a radio at 70,000, and when I come to the shop, you tell me it is 80,000, I struggle to bargain to come to my expected expenditure, to come within my utility. I feel this radio should be enjoyed. The service of this radio should be enjoyed at 70. That's why this seller, when you are bargaining, he tries to show you the different functions, the different benefits of this radio. You want to pay 70, but this radio has FM, has shortwave, has a Bluetooth, has this. By mentioning all these, he wants to increase your utility. He wants to increase your satisfaction, so that your satisfaction, once it is increased, you are going to be willing to add to what you had expected. If you fail because the money is not there, your utility, in your mind, you know that this radio is very good. This radio has a lot of satisfactions it can give me. I had planned 70, but the man is saying 80. So you bargain. You want that utility to be enjoyed at 70. The man is saying 80. By bargaining, I said there are two situations. By bargaining, you want to bring that utility, that price into your utility to 70. If finally he accepts to take 70,000, that means you have no surplus. You have spent on your utility. Your utility was on the product was 70,000, and it is actually what you have got, 7,000. That's what you have got from your utility, from the product. But if you wanted to spend 70, the man says 80, you bargain. This is the second situation. You want to spend 70. The man is mentioning say 80. You bargain, you bargain, you bargain. That's what we call haggling. And finally, he says, okay, pay 65,000. By paying 65,000, it means you have got a consumer surplus of 5,000. You were ready to take that product at 70. That is the utility you had calculated. Now, you realize that it is less. You are buying it at 65. So you are pocketing 5,000, which you may find that it has nothing else you are using it for, because the utility is already achieved. So your surplus is 5,000 shillings. But that has been attained after the bargaining. So when you go to the market, in most cases, to rational consumers, when you go to the market, the seller is trying to ensure that he gets to your utility, because you don't express it immediately. That's why you say the radio is 80, and for you don't mention 80. You are ready to pay 70, but you mention 50. Then he goes down as you come up. As he pushes you up, he wants you to reach your utility, which you planned. But if at the end of the day he fails to reach your utility, and you get it at 65, he will not know. But for you, in your heart, you know that after pushing it to 65, I have got a consumer surplus of 5,000. That's what we call consumer surplus. So bargaining usually brings in that aspect of consumer surplus. The seller wants to sell to you the commodity at your consumer expenditure. And for you, you want to increase the surplus. So you mention 50, you bargain, but when you know that you are ready to pay 70, and after paying 65, you can tell your colleague, I had brought 70 for this radio, but luckily enough, I've got a surplus of 5,000. So that is the what you call the consumer surplus, and I'm sure it is clear. Both definition, we have defined what it is, we have illustrated what it is on a diagram, and we have illustrated what it is mathematically by figures. So now, I'm sure as a student of economics, now you can talk of consumer surplus and express it very well. Now, what are the benefits? Benefits of consumer surplus. What are the benefits of consumer surplus? What do we get? What are the gains of consumer surplus? If I make this surplus, what is the benefit? What advantages are there from the surplus? If I was supposed to spend 800 on sugar, that's what I planned, and I put it on paper. But finally I spent 240. What is the benefit of this 570? Number one, allows the consumer to buy other goods. Now Now with the 570, you are going to buy what you did not plan. In other words, you went to the shop to buy only sugar. Lucky enough, see the situation, you are now going to buy other items using this 570. So it helps you to buy other commodities, which you had not planned to buy because your expenditure was only on sugar. But with the existence of the consumer surplus, you can now buy other commodities using the consumer surplus. 2, increases savings of the consumer. The savings are increased. Why? The consumer who had made this budget, I'm sure his income is not 810. He had put aside some savings. Assuming he had put aside 3,000 shillings as his monthly saving after looking at all the expenditure. After buying sugar, he has added on the savings 570. 3,570. Now that's what he has as his savings. So it increases savings. Consumer surplus increases savings. Then another advantage is that he had to buy 8 kilograms. So it increases the amount of goods to purchase. This consumer can now buy 15 kilograms. So it increases the amount of commodities he is to buy. He wanted to buy 8 kilograms. Now with 8, he has bought it at 240. He can now double. He can buy 16 and will still spend 480. Still below. So he can buy, the first one is allowed to buy variety of commodities. He can buy sugar. He went to buy sugar, he buys the 8 kilograms. The wife or the whatever will see him coming back with the sugar, with the salt, with the soap, say, hey, where have you got the money? The money is not got from anywhere else, but from consumer surplus. That is the number one. But number 2, the man who went to buy 8 kilograms is coming back with 16. Say, what happened? It is because the price was found lower than what he had expected. So there's that advantage. You buy more output than what you had planned to buy. So it increases the variety, it increases even the amount. 4, improves the standard of living. It improves the standard of living of the consumer. Standard of living of the consumer. Because he has bought varieties. So he can now improve the standard of living by purchasing various other commodities. It encourages investments. It encourages investments. Why? Because he has saved 570. If he saves such on about 10 items, he can use that money to make investment elsewhere. He can make his own investment. So that is another advantage, that he is going to be able to make various investments. Then number 6, this now is not to the consumer. It is to the advantage of the government. It increases tax levy. How does it increase tax levy? This man was to pocket this. If there is a tax which is imposed on every item you buy, that means by buying other items, government collects more revenue on number 1 and number 3. By increasing the number of kilograms, the amount of kilograms he's buying, he's paying. If each kilogram has, for example, 10 shillings or 5 shillings as tax, on 8 kilograms, he was going to give government 40 shillings as tax. Now, if he doubles and makes 16 kilograms, he's going to give government 80 shillings as tax. If he goes to variety, each commodity which he's buying has a tax. That means he's going now to the government is going to collect more tax on the various commodities he is going to buy. So it increases the tax revenue. It increases the tax revenue to government. And I've said, how does it do this? Because the 570 which you would have pocketed, you have now spent it on other commodities. That is the number 1, on other commodities. So therefore, all those commodities, if they carry, like the indirect taxes, if each commodity carries a tax, that means you are paying more tax now using this, which you would have kept. Or if you increase the amount of sugar which you are going to buy, and each kilogram has a tax, it actually means that now you are paying more taxes on the more kilograms which you are purchasing. So these are some of the benefits that you are going to encourage to have. Then possibly another advantage is that it increases sales of the sellers. By putting this price at 30, it means that you are buying 80 kilograms at 30. When the consumer surplus is there, that means you are going to double. Say, oh, it is 30. Now give me 20 kilograms instead of 8, which had come for. That means the seller is going to have more sales from the consumer surplus. So it increases the the sales of the sellers by the consumer using the consumer surplus to buy more commodities or to buy a variety of commodities. So those are the benefits that we are going to have when you gain a consumer surplus. I think this exhausts and it fully explains the consumer surplus. We started by defining it. You know now what the definition is. From the definition, we illustrated it using a diagram, which you have already seen, and you have also illustrated it using figures. That is the mathematical representation of a consumer surplus, meaning that in any form of exam that may come, whether you are told to illustrate, you know. You remember that when you are talking about illustration, the price must be the market price. Whatever is above is the consumer surplus. With the figures, you have to get the market price, which is here, and then whatever is saved above the market price is the consumer surplus, as we have calculated. Now we are moving to another area in our price theory. Still, we are looking at going back to the demand curve. Why is the demand curve sloping downwards from left to right, downwards? Why does it have a negative slope? That is what we are going for in the next consideration. Still under price theory. We are still under price theory, and in price theory, we are still looking at demand. why is the demand curve moving downwards from left to right?